Hi, and welcome to this quick take. We're continuing our discussion on the Genius Act with respect to both the permitted payment stablecoin issue requirements and also what the construct of the actual stablecoin itself has to be like. A lot of ground has been covered in the prior two episodes, so I would certainly recommend going back and taking a look at those. I may speak colloquially or use jargon or make references to earlier sections. And without seeing that, you're really maybe not going to be able to follow along. Just some housekeeping. Again, I'm Howard Krieger, not a tax professional. I'm not a lawyer, definitely not an investment professional. None of this is legal, financial, tax advice at all. I do have a background in structured finance and regulatory matters, and so I've had to read a lot of these requirements and what have you. But again, do your own homework. So we're through at this point the basic underpinning of what a permitted payment stablecoin issuer is, or who has oversight over them. And we did talk about what the coin has to be. It has to be on a ledger. And we talked about the reserves quite a bit in the last episode and what qualifies and what doesn't qualify. And now we're getting into more of the nuances of, okay, are you a public company trying to issue a coin, a private company, and what have you. And then as these kind of various issues come up, then certainly they try to address it in the act. Things to look for is language usage. The words that are used and the priority of the statements speak a lot to what the legislature is thinking or is going to be problematic. The sophistication of the language is also important, right? So I can tell right now that this Genius Act was written by people that understand the space because they use the term burn, like burn tokens, which I've never seen in legislation before. So that's pretty cool. So I'm going to go ahead and share my screen. And if you've been here before, great. If not, then what happens is I basically have gone through and read this act. I've highlighted certain things that I found pertinent. It doesn't mean that they are. It's just more of a memory aid. I usually get my little squiggly do here and read along with you as we scan it. I'll make it a little bit bigger to try to help with the legibility. And let's see where we are. So we left off here where stablecoins can't pay interest, and now we're talking about non-financial service public companies. So a non-financial service public company, a financial activity defined by the Bank Holding Act. A public company is one that's regulated, right, by the SEC. A public company that's not engaged in one or more financial activity may not issue a payment coin without unanimous vote of the Certification Review Committee. I think that Certification Review Committee is the same three people, the head of the head of the SEC, right? The head of the Board of Governors, is that right? And one other. Again, it's in the first episode we talked about who the regulator body is, but it's like three people, and usually 2 out of 3 have to decide. But here it's saying unanimous. So you're a public company, you own a bunch of stuff, you want to originate a permitted payment stablecoin, you're not going to be able to do it without unanimous consent, and especially because they don't want to pose material risk to the safety and soundness of the United States banking system. Honestly, you can't blame them. What else is more important than that? So we scan through here. I'm going to be skipping a lot of pieces in here. Doesn't mean that what I'm skipping isn't important. It just means that when I glanced over it the first time, it didn't jump out at me as anything more than typical kind of legal block and tackle. Company not domiciled in the United States or its territories may not issue a payment stablecoin unless it gets a unanimous vote also. So they talk about the different areas of the country an issuer can be from. This is saying also if they're a public company from those outside areas that isn't engaged in a financial activity primarily, they're going to have a hard time being approved to issue their own token. Not impossible, just they, if they need 3 votes, they got to line 3 pockets. Okay, construction, the fines, and really, like we talk about, this is interesting, state versus federal levels. So, like $10 billion and below of stablecoin can exist under a state level regime. We'll talk about it later, but if they get over that remark, they're compelled to go into a federal regime. Uh, Annual recertification. So it's the Secretary of the Treasury, um, not later than a date to be determined. A state payment stablecoin regulator gives the review committee certification uh, of everyone that it's certified. So, like, okay, so a state can permit a stablecoin, payment stablecoin issuer. Here it's saying every year that the state has to basically tell the feds, yeah, the certification's still good, all those companies are good. Which means if you are a state operator, just expect that a lot of your calendar year is going to be getting the information to those guys that are going to be taking it to the treasurer. The Secretary of the Treasury shall publish and maintain a list of the states that have submitted certifications and recertifications. So you'll know and be able to research whether your state has other permitted stablecoin payment issuers in it. A state chartered institution with more than 10 billion has to transition to the federal regulatory framework. They have a year to do so. Look at 360 days. Let's see. They'll remain solely advised by the state otherwise. The primary federal payment stablecoin regulator shall consider the following: whether or not to waive the transition requirement, the amount of capital maintained by the state, the operations of the issuer, the experience of the state regulator, like, hey, maybe you had done this at the federal level and you just decided to move back to Arkansas, and that's kind of where you're going to be the state regulator. And then also the framework, like how tight is the framework in comparison to the national one, right? This is a huge point. This is why it's circled like 3 times in red. This is in the act. Payment stablecoins are not backed by the full faith and credit of the US. They're not guaranteed by the US government. They're not subject to insurance by the FDIC or the NCUA. Does that mean bespoke insurance can't be obtained? No. There can be bespoke insurance, like from a Lloyd's of London or what have you, but everyone should know. This is really to the public, right? This is to John Q. Public and Jane Q. Public, that payment stablecoins are not backed by the full faith and credit. That could be an issue when you couple it with what we talked about in the last episode about if the money market fund that they're in breaks the buck, or the tokenized version of the asset fails, and you're still left holding the coin. Your recourse is going to be limited to like the actual like capturable reserves. And they do talk in here about bankruptcy rules having to be updated, but they're moving forward with this and expecting that the other institutions that are affected in the event of a payment stablecoin downturn, that other entities are going to change their rules to be able to again protect consumers, but in this new technological framework. For the purposes of determining violations, if a single act are, if something's done wrong across many people, a common or substantially overlapping originating cause, or the same statement that affects, it's going to be treated as one violation. In the first episode of this series, we talked about how the violations are limited, I think, to like $1 million per incident. There are other penalties that can amount to like 500,000 a day for non-compliance. But if this is strictly a one-shot, they made a mistake, the issuer made a mistake, they're only paying $1 million. And I say only because on a $10 billion treasury pool, right? So on a $10 billion treasury pool, there's $1 million right there, right? So a BIP a BIP penalty basically, I'm sure they can handle it. Not a very large incentive to not make a mistake. Now, obviously, negligence falls outside of this. Okay, determination. No individual. So people working at the stablecoin issuer, officer and director level, cannot be hit. And then here's the $1 million penalty per. Right, skipping ahead, approval. So essentially, the federal government here is saying, look, you submit an application, we promise to review it. And they're going to review them very quickly. And in fact, if the applicant demonstrates the ability to meet the requirements, the onus almost falls on the federal government to make sure that they respond in time if they do challenge. Because if they don't challenge in time, then that application is considered approved simply by the clock running out. But they got to show competence. They have to show the ability. They have to have a redemption policy. Remember, we talked about earlier where these institutions have to demonstrate it's the intent to keep the reserve. They have to have they have to communicate that they intend to abide by. They don't actually have to necessarily keep the reserve, which I'm sure other aspects of this force, like making sure that there's money in the bank to back it. But they if the issuer acts as if they intend to hold the reserve, then that's good enough for at least one of these requirements. 30 days after receiving the application, the Fed can reply and say, nope, not complete. They can't say yes or no. They could say whether it's complete or not. If it's not complete, it goes back for more information. Excuse me. If they go back and say, hey, there is sufficient information here, and that the issuance of a payment stablecoin shall. So it's really a question of safe and soundness. So a primary federal payment regulator can only deny a complete application if they feel that the applicant would be unsafe and unsound. Being on an open, public, or decentralized network is not grounds for denial. So if you're a stable coin, on Maker, right, which they have DAI, right? So DAI, there's probably other reasons why DAI is not a valid stablecoin, nor is Maker a permitted payment stablecoin issuer at this juncture. But when they check all those other boxes, being on a public chain is not going to be something that can be the only grounds for denial. Later than 30 days after the denial, the applicant can request a hearing. So it's like 30 days. Do you have the right amount of information? Great. Another 30 days, you're either accepted or denied. If you're denied, you can go to an appeal. And then 60 days after the date of the hearing, the regulator will notify the applicant of the final determination. So all told, worst case scenario, if you have all your ducks in a row, from application, from going from the application of being a permitted payment stablecoin player through to a yes, looks like 4 months on the outside, maybe 6 months. That's not bad. This is the big one here, right? If the regulator fails to render a decision, then it's approved, right? The applications need to be reported to Congress. There are requirements that can be waived by the regulator. In some cases, there might be a subsidiary of an insured entity that can kind of be fast-tracked through the application process. Okay. And we're going, more rules, supervision and enforcement. You can see how much I love reading this stuff, right? Federal payment stablecoin regulator. So, okay. The primary federal payment regulator that is not a state issuer, blah, 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 may prohibit permitted stablecoin issuer from issuing stablecoins if they feel that the party has willfully or recklessly violated the act. ceases and desists. Here's where the government can step in. That the federal government has procedures for essentially it reads like a takeover without saying they're going to take over. The procedures that are afforded to them if the issuer has committed some high level violation. Maybe it's a case where the reserves aren't really there, and the procedures that the federal government can rely on are the same procedures that they have under the FDIC. So I guess they can still step in and kind of bolster the reserves, but clearly they're not offering insurance. But this act draws on those going in and taking over scenarios if they need to. And then, of course, there's other remedies like injunctions. There's civil penalties of X amount per day, 100K a day. It's a lot. Let's see. This talks about if people leave or resign, depending on their level, they need to report it to the issuer. All the kind of standard stuff you'd see almost with a financial institution or a public company. That if there's some material change to the business, that business needs to report it. So I'm going to try to rip through the last bit here. We might run a little long, but again, this is a lot of it's cleanup. So anti-money laundering protections. Again, we'll find out what that means with respect to do they have to have AML and KYC, which again, a lot of stablecoin issuers do not have today. Yeah, so national security waivers, law enforcement waivers, and for some people this stuff is important, so I recommend you taking a look at reading. But for our purposes, it's just more of the same, right? It's basically the government like letting you know that you can't stop it from doing its work, especially when you've put your customers' livelihood and financial well-being on the line. There's a commitment to anti-money laundering innovation. And the Secretary of the Treasury is going to seek public comment on these novel methods using APIs, AI, digital identity verification. A lot of people identify verification. I think it's identity verification. So it could be a spelling error. Love when I find spelling errors in signed acts and blockchain technology. So this is like, hey, we're going to try to be better at AML. This could come because also the broker rules that are coming up do require certain information around the transaction being maintained along with the dollar amount. So that might be an attempt to get ahead of it. Like, hey, brokers, if you figure out how to do AML and KYC, let us know and we can force our stablecoin people to do the same. Here, FinCEN is going to have rules. They have 3 years to issue public guidance and notice and rulemaking comments. The results of research and risk assessments that are being asked for here. So they've got 3 years to basically study what the existence of these permitted payment stablecoin pairs in the marketplace has had. Looking at standards to report illicit activity, to monitor transactions on chain, even those that go through different tumblers and mixing services. Good luck with that. Okay. Custody of the reserve collateral. A person may only engage in the business of providing custody and custodial services for the reserve. The payment stablecoins use as collateral or the keys. So they don't want the person providing custody of the stablecoin reserve or the stablecoins or the private keys to hold other stuff. Complies with such requirements, blah, blah, blah. Very good. Payment, stablecoin reserve payments shall be separately accounted for, right? So no commingling. It can be commingled in an omnibus account under certain circumstances. So the payment stablecoin reserves shall be not subject to the requirement related to separation at the institution. I think that it's the reserve, the stablecoin, the cash may be commingled, holding the payment stablecoin reserve. more of more than one stablecoin issuer. So that means that multiple state issuers could have their stuff commingled. Obviously, it's up to that custodian to provide separate reporting because that looks like it would be a mess. An insured depository institution can also provide the custodial services. Priority claims, the stablecoin holder has priority over other claims. Okay. This is the bankruptcy one, right? So notwithstanding, if a payment stablecoin holder is not able to redeem outstanding payment stablecoin claims, then the payment stablecoin shall have first priority over any other claim, including any other expenses and claims that the permitted payment stablecoin person has incurred. So no body gets in line ahead of the payment stablecoin holder. My guess would be the difference would be if it was like margin on a big structured transaction, but maybe not. Maybe that's something that the injured party could sue for and say, hey, we should have gotten that margin money back before it went to settle some claim. Okay, there's going to be studies and gaps in use cases. They're looking here, they want to see interoperability standards created so that the one permitted payment stablecoin can, go from network to network and interact with the broader digital finance system. Is this a backdoor to the CBDC, even though they just issued an anti-CBDC law? Maybe, maybe not, right? Maybe this is just literally like, hey, they'd like to see all technology work with all other technology. Okay, it's no big deal. And a lot of nuances, and they do a nice job of identifying facts and circumstances which are kind of obtuse but could happen, and where they've played whack-a-mole. And then there's other cases where you're scratching your head, like why would they allow tokenized assets and reserves? Why would they allow money market funds? So it's a mixed bag of an act. Here they explicitly claim that a stablecoin is not a security. They also say it's not a commodity. And each one of these sections talks through a different legal act and how whatever the definition in that legal act is of security or commodity, the stablecoin in this case, a permitted stablecoin, will not be either. Okay, and public available, foreign countries. We've seen that before. And we're just about, here you go, effective date. So 18 months from now. So that's 6 plus July. July is the 7th month. So January of 27 is the date that is the date, or 120 days after the regulators issue final regulations. So my guess is it's going to be the January 7th, 27th. So that is the entirety of 1582. I hope you enjoyed these 3 episodes. Again, not a tax professional and not an attorney, just someone who really is interested in this stuff. We're going to go through the Clarity Act next and the anti-CBDC law. So be sure to, if you like the material you saw today, and there's other videos available, just like and subscribe to this channel. And we will see you when we see you. Thanks again, everyone, and have a great day. Bye-bye.